the emergency action taken by the Federal Reserve has shaken the foundation that investors have relied on for many years. In a brief moment, the seemingly stable order of the financial world shifted in a way that very few were mentally prepared to face. When the most powerful financial institution on a global scale is forced to act outside of expectations, it is rarely a sign meant purely to reassure. For anyone investing, running a business, or simply protecting assets for the future, understanding the nature of this moment cannot be avoided. Its impact will reach every unit of capital, whether you actively follow the markets or not. It must be said clearly that this was not a routine policy announcement or a technical adjustment. This is the kind of decision that will be discussed years from now in economics textbooks and serious debates about financial cycles. Such decisions can alter destinies, turn confidence into caution overnight, and more importantly, force investors to redefine the boundary between safety and risk. Moments like this are rare in finance, but when they occur, their consequences run far deeper than what appears on the surface. At first glance, this may sound dramatic, but those who have watched markets long enough understand that when details begin to emerge, the level of risk is often far greater than it initially feels. For many months leading up to this point, the global economy had been under quiet strain. Inflation refused to cool as expected. Growth was uneven and fragmented. Every statement from the Federal Reserve was dissected word by word by analysts, traders, and observers as if searching for clues to something left unsaid. Even the most seasoned participants did not anticipate this move. In an unscheduled emergency meeting, the Federal Reserve announced a series of forceful measures aimed at stabilizing the economy and restoring market confidence. Headlines spread quickly, but the true story was far more complex and consequential than any short news summary could capture. What unfolded was not merely a reaction, but an acknowledgement that pressures had accumulated to a point that could no longer be ignored. So what exactly did the Federal Reserve do? Put plainly, it crossed familiar boundaries and activated emergency mode. A sharp reduction in interest rates at a scale rarely seen since past crises, combined with a new round of quantitative easing, signaled a determination to inject liquidity at any cost. The commitment to purchase large volumes of government bonds and mortgage-backed securities was not only meant to support markets, but to send a clear message about the seriousness of the situation. Even more striking was the launch of direct lending programs. On an unprecedented scale, these programs were designed not only for banks, but extended to businesses, local governments, and even households. Such actions rarely appear in normal times. The natural question is, what forced the Federal Reserve to move with such speed and force? The answer lies not in a single factor, but in the convergence of multiple economic pressures that had been building for a long time. Inflation, once believed to be temporary, proved to be stubbornly persistent. Prices rose broadly across essentials and housing, eroding purchasing power and confidence. At the same time, growth slowed, labor markets lost momentum, and stock markets became more volatile than ever when geopolitical shocks, supply chain disruptions, and growing uncertainty about the future converged. The overall picture began to resemble a crisis in the making. The emergency response from the Federal Reserve was therefore a reflexive reaction to this reality. It aimed to reassure, to calm fear, and to signal that the central bank remained willing to intervene to prevent a far worse outcome. But as any experienced investor understands, no action comes without consequences. Those consequences will not be limited to weeks or months, but may unfold over many years. The market initial reaction followed a familiar pattern. Stocks surged, bond yields fell sharply, and currencies swung as traders tried to adapt to the new environment. Yet as the early excitement faded, difficult questions began to surface. If the Federal Reserve was this concerned, what was happening behind the curtain that the public had not yet seen? Was the economy far weaker than official figures suggested? In theory, low interest rates and loose monetary policy are expected to stimulate growth and support asset prices. In reality, outcomes rarely follow straight lines. When a central bank acts with such force, it can also be interpreted as a signal of distress. That is why, after the initial surge, markets quickly moved into a phase of adjustment as investors reassessed risk in a world where old rules were being rewritten. Looking back at history, the last time the Federal Reserve acted in emergency mode during a full-scale crisis, its intervention was seen as a lifeline. Today, however, the economy is not collapsing, but it is fragile. Risk now comes not only from finance, but from politics, society, and global interdependence. Tools that once worked effectively may no longer deliver the same results. For investors, this means re-examining long-held assumptions about risk and return. The belief that one can simply buy market declines and rely on central bank protection may no longer hold firm. In a world defined by uncertainty, prudence, flexibility, and discipline become assets as valuable as capital itself. For businesses, the message is equally clear. The cost of capital may decline, but instability in demand, supply chains, and consumer behavior continues to rise, preparing for multiple scenarios, including those once considered unlikely, is no longer optional but essential. For those simply seeking to protect long-term savings, the core lesson remains unchanged. Diversification, discipline, and the willingness to question old beliefs are the best defenses in a world changing faster than expected. What the Federal Reserve has just done is not an isolated event. It is a critical move in a global chess game where every decision is watched and responded to almost instantly. This emergency action is therefore not only a message to Wall Street, but a reminder to the entire world that the era of certainty has ended. A new phase of risk and opportunity is unfolding. Only those able to look beyond the surface will be capable of navigating it wisely. The sense of comfort that once allowed businesses to plan far ahead and investors to sleep peacefully with the belief that the rules would not change overnight has now faded. The emergency move by the Federal Reserve, seen through a long historical lens, is a clear admission that the pressures building beneath the surface have grown far beyond what is considered normal. They are larger, more complex, and more urgent than anything a single generation of investors has had to confront directly. Stability, once treated as a given, has become a fragile variable. At moments like this, psychology begins to matter as much as mathematics. Markets run on numbers. That is true. But they are also driven by collective emotion, by fear, by hope, and by the shared mood of millions making decisions each day. When a central bank acts with visible urgency, confidence that was already thin can begin to fracture. It does not take a dramatic change in fundamentals. Sometimes uncertainty alone is enough. To trigger a chain reaction, many investors quietly ask themselves, if those in charge are this concerned, should I be concerned too? This is how anxiety spreads, even when reality is less dramatic than the headlines suggest. Yet seasoned observers know there is always another side to the story. History shows that every crisis, no matter how damaging, also creates opportunity. For those with patience, discipline, and clarity, when old rules stop working and familiar models lose their power, new leaders often emerge. The companies, industries, and individuals that adapt the fastest tend to move to the front. This pattern appeared during the global health crisis, when organizations that embraced technology, remote work, and digital transformation did not merely survive. They accelerated. The same pattern followed the financial crisis many years ago, when a new generation of technology firms rose from the collapse of the old system and reshaped the economy. So the real question is not whether opportunity exists, but where it will appear. The actions of the Federal Reserve suggest that interest rates may remain lower, for much longer than previously expected. That environment favors borrowers, homeowners, businesses, and governments seeking to refinance debt or invest in future growth. Cheap capital tends to support sectors that depend heavily on financing real estate, technology, and discretionary consumer businesses may benefit if low rates persist. But the downside is equally real. Low interest rates mean lower returns for savers, retirement funds, and anyone relying on fixed income. The search for yield intensifies, pushing capital toward riskier assets. Equities, high-yield bonds, and speculative markets draw increasing attention. This combination fuels volatility, encourages asset bubbles, and leads to sudden corrections. When sentiment shifts, the lesson is not new, but it is more important than ever. Do not chase returns blindly. Understand the risks you accept. Maintain diversification and prepare for sharp moves, and another dimension appears in global markets. The actions of the Federal Reserve almost certainly place downward pressure on the value of the United States dollar, at least in the near term. A weaker currency cuts both ways. It improves export competitiveness, supporting manufacturers and multinational companies. At the same time, it raises import costs, adds inflation pressure, and strains nations that borrow in United States dollars. For international investors, this is a moment to reassess currency risk, explore opportunities in emerging markets, and hedge against further depreciation. Politics cannot be separated from this picture. Emergency actions by the Federal Reserve have fueled intense debate. Some argue the central bank has gone too far, inflating asset prices and worsening inequality. Others believe these steps are necessary to prevent a deeper collapse. Both perspectives contain truth. The central bank is walking a narrow line, trying to preserve stability while risking unintended consequences. For investors, this makes clear thinking essential. Stay informed, filter out noise, and focus on long-term structural trends behind every policy decision. Are real people, families trying to buy homes, retirees living on fixed income, workers concerned about job security. These decisions affect them immediately, and over time, mortgage rates may fall, helping some buyers. But persistent inflation can erode savings and strain household budgets. Markets may recover, yet volatility alone can create anxiety. In such an environment, financial literacy is no longer optional. It is protection. Do not rely on headlines or quick tips. Take time to learn, question assumptions, and make decisions aligned with your own goals and risk tolerance. This emergency move is not the end of the story. It marks the beginning of a new chapter. The choices made now and the strategies adopted will shape who weathers the storm and who captures opportunity afterward. Shockwaves continue to spread. The line between safety and risk is blurring rapidly. Stock markets reflect this clearly, with sharp swings following the announcement. This is not random noise. It shows a market searching for footing in a world where rules can change overnight. The long-held belief in a permanent safety net is being tested. As that certainty weakens, investors are forced to rethink old strategies. Buying every dip, ignoring risk, are losing relevance. Attention is returning to quality. Strong balance sheets, reliable cash flow, and resilience are back in focus. Speculative assets face harsher reality. Easy money may not be gone, but it has entered a more unpredictable phase. Bond markets reflect the same shift. Record low yields make safe income difficult to find. Savers, retirees, and cautious institutions are pushed toward higher risk just to meet obligations. This reality captures the depth of change now reshaping the financial world. The search for yield, when pushed too far, rarely ends with reward. it often ends with fragility. Capital begins to flow into riskier corners of the market. Emerging market debt, high-yield bonds, private credit, these areas promise higher returns, but they also hide weaknesses that remain invisible in good times. When inflation stays elevated or growth slows, these assets are often the first to crack. Real estate is not immune to this shift. Lower interest rates should make borrowing cheaper, in theory. In reality, the picture is far more complex. Supply chain disruptions persist. Labor shortages continue. Construction costs remain high. Home prices rise faster than incomes. First-time buyers are increasingly locked out. Commercial real estate faces its own pressure. Remote work and changing consumer habits are quietly reshaping demand for offices and retail space. Actions by the Federal Reserve may offer short-term relief, but long-term clarity remains elusive. In this environment, alternative assets draw more attention. Gold reasserts its role as a safe haven. Investors seek protection from inflation and currency risk. Digital assets remain controversial, yet they are no longer fringe. Volatility is both their promise and their warning. Art collectibles and farmland also attract capital. They offer diversification beyond stocks and bonds. The deepest shift, however, is psychological. Emergency actions by the Federal Reserve have weakened the illusion of stability. The belief that central banks control outcomes, that markets always recover. That risk can be managed by simple rules. These assumptions are now being tested. Some investors respond with discipline. They reassess risk. They stress test portfolios. They prepare for uncomfortable scenarios. Others retreat. They raise cash levels. They prioritize capital preservation. Moments like this reveal contrast. Some see only crisis and chaos. Fear drives rush decisions. Others look through the noise. They recognize that instability creates mispricing. Quality assets are rarely cheap in calm periods. History shows this clearly. Great fortunes are often built when the crowd moves in the opposite direction. Courage does not mean recklessness. Balance is the true skill. Calculated risk matters. Long-term focus matters more than rigid strategy. In a fast-changing world, adaptability becomes the most durable asset. Old assumptions no longer guide the future. Successful investors think independently. They act decisively when opportunity appears. They remain disciplined when others lose direction. The actions of the Federal Reserve are not a final solution. They are only one tool among many. True recovery requires more leadership, innovation, and the willingness to face difficult realities. The future remains uncertain, but uncertainty often reveals opportunity. To those who stay clear-minded,